You saw the data. It was all there, suggesting, at least on a historical basis, we were headed towards one. You had a yield curve inversion that was the worst that we've seen since the financial crisis. What happened?
Well, 100% is tough in markets, so I would caution your economists from always doing 100% probability. At least put a 99.9 on it.
Pass that on to them.
That's why, yeah, and I would never say zero either. At least, that's called infinitesimal on the other side. So that's just my little mathematical brain. But at the end of the day, I think what's happened there is that those risks still are present. And so the thing is, the yield curve is still inverted. This is one of the longest tenures of yield curve inversion when you look at like 2s, 10s since really back in the early 40s. And so it's really problematic that you see that the market is really fighting the Fed here too. And so the market, the rallies we've seen, what we've been calling the everything rally since November 1st, really just started to really be predicated on rate cuts again. So if the Fed was really tried and true with their higher for longer mantra, I think that we would get closer to the recession. And you know, when people call for soft landings, usually what that means is that there's some problematic area of the economy. It just doesn't have the breadth across. That's what makes it a hard landing. And so I still think that there are still some challenged areas, but if we start to see some of these rate cuts, maybe some of those problematic areas do get skirted, and the Fed achieves the miracle of being able to really navigate this hiking cycle and be able to normalize policy back without causing pain. The problem is that historically, the Fed has a 100% track record in most of these instances of causing a recession, at least when they stay dedicated to the hiking cycle.
Right, right. Well, interest rates are a very blunt tool when it comes down to it. You mentioned risks. What is the bigger risk right now? A reignition in inflation or a stronger than expected labor market, which is kind of what we're seeing signs of right now?
Yeah, I think the labor market has been relatively strong. I know a lot of people question it, saying, you know, is it the birth-death model? And, you know, we've seen some net revisions negative, but on whole, the labor market has held up pretty resiliently. And when you look at unemployment claims today, the new data coming out, whether it's continuing or initial claims, they're not putting up red flags at this point. And so I don't think that the labor market is going to reignite, and you're going to start to see 300,000 and 400,000 jobs per month being created. But I do think that the bigger risk is the inflation. And I think the Fed will have concerns about some of this, which is why we kind of scratch our heads with Jay Powell at the last press conference. You know, in November, he talked about financial conditions being tight, the bond market signaling it, then rates rally, financial conditions ease. Made no mention really of it at the last press conference. But if the Fed does believe in these wealth effects that we heard from Bernanke in 2 administrations ago at the Fed, that ultimately, you know, when people feel wealthier, risk assets rally, their portfolios go up, they spend more, maybe then all of a sudden this starts to cause some concern at the Fed that we start to see this kind of reacceleration of inflation. But at this stage, we see core inflation has been dampening. The trajectory is right, but the market is definitely extrapolating this into that the Fed is going to normalize policy back to a much lower rate. And it just seems that it's a little optimistic today to think that's going to happen so soon as early as March.